All right, so today I wanted to talk a little bit about bonds, and I kind of wanted to bring something up that I think is getting to be more popular belief in the investing industry, but I think it's probably should be talked about more. And that's the idea that bonds are super safe, right? This is something that you always hear is, stocks are more aggressive or, risky and bonds are safe. Now, the first caveat I would point out is that I do still think technically bonds are more safe. Now, this is where the real debate comes down to. Number one, what's your time horizon? Because if your time horizon is 10 or 20 or 30 years versus 5 years or 2 years or 1 year or 6 months, it's going to be a completely different debate. And number two, you also have to look at are we talking about nominal or real returns, right? Because if you factor in inflation, well, bonds are going to look a lot worse, right? Because, I mean, if you have inflation running at 2% a year, which probably is an understatement, let's just take that number though, and bonds are returning 5% per year or 4% per year. I mean, what the 10 years at what, 4%? Um, but this, stocks are going to return 8% or 10%. Well, yeah, stocks are a lot better, right? But if you're looking at nominal, right? I mean, yeah, bonds might look a little bit better. But what I wanted to bring up here is this is the ultra short 20-year Treasury. So they're shorting the TLT, which is the long-term Treasury ETF, right? And this fund's up like 40%. Now it is a 2x fund, so it is it is a leverage fund. This is a fund or a ETF that I've been in for a decent amount of time. I went in around, I think, 22 or 23. Did go out recently, which I do regret a little bit because it definitely could have made more returns. But um, this is something I think was a fairly easy play, and it shocked me that there wasn't more people doing this because, again, when the Fed when the Fed stops QE and they start raising rates, well, the long-term bonds are going to get killed, right? Because QE is literally buying long-term bonds. When they stop doing it, well, obviously the price is going to go down, right? And not only that, when rates go up, it's going to put pressure on those longer-term bonds, right? Now it's going to put it on all of them, but especially the longer-term ones. Those are the ones that are going to get hit the hardest, and especially when we're on the brink of a recession, right? I mean, who wants like, and this is the thing, like, to just think about it from a logical perspective, right? When you have a government that has $31 trillion in debt, it is an obvious risk in my mind to be lending them money for 20 or 30 years, right? Especially at a rate that is significantly lower than inflation, when you could get the same return for, a much shorter period of time, right? So like what I believe is investing in bonds makes virtually no sense, right? I mean, this is one way of doing it that made a lot of people a lot of money, me a little bit of money. But again, if we look at the TLT here, um, again, year to date, this fund started the year at 142. It is at 99. So again, this fund is literally down 40%, right? 40%, right? And it only has a what, 2.34% dividend. Like, and again, one of the big pushbacks against this will be, oh, well, if you buy individual bonds, you'll be fine. And that is true, right? Again, though, I think the better way of putting it is buying a bond fund is terrible idea. Now, the only ones that are considerable, in my opinion, would be short term, specifically corporates, because, I mean, number one, if you're going to take any risk, it is better to take credit risk than duration risk in this kind of a market. And number two is you want it to be short term because, well, for obvious reasons, right? I mean, if you're still going to get a comparable rate of return, why it just doesn't make sense to go long term, right? And again, the credit thing too is that um, if you're taking a high yield even if the rates, even if their creditness or their credit rating goes down a little bit, like you're still not going to get hit as hard as the government ones would, right? So there's a lot to go into, but again, in my opinion, it's like it's the risk versus reward, right? The best case scenario with bonds, okay, you return 5% a year, 6% a year, like you're literally your best case scenario. But the downside is what? You lose 20, 30%. But the upside of stocks is, okay, you could lose 30, 40%, but you could gain 50%, 100% even, right? Let's just say 50 to be a more reasonable number, right? In the next year, right? Because if the Fed goes back to QE and lowers rates, would it surprise anyone if the S&P or especially the NASDAQ went up 50% in 2023? Like, I don't think it would. Now, do I think that's going to happen? Absolutely not, right? I mean, personally, I think that they're going to raise rates more than people think. There's going to be pain. We probably haven't seen the bottom of the market yet. And the real question is inflation, right? If inflation can tick down, we'll be okay. But I think that this is going to have to get worse. And again, the other thing too, when it comes to bonds too, is that what is the upside? Like I say, what is the upside? Like if you're not keeping up with inflation, you're still losing money, right? You're still losing money. So here's the thing, like as a long-term investor, I just think it doesn't make any sense, right? I just think it doesn't make any sense, right? Again, if you're going to buy individual bonds, by all means, but how many people are actually doing that? Right? How many people are actually doing that? Most people aren't. Most people are, they're either buying a bond fund or they're buying a mutual fund that has a manager that is buying the bonds, right? But again, the other big problem is the long-term debt, right? The long-term debt, because no sane person's buying a 20 or 30-year treasury right now, right? Why would you when you can get the same returns on the shorter dated ones, right? Doesn't make any sense. And the other problem with that too is you're still not even keeping up with inflation, right? So again, just something I wanted to bring up because I think that the way a lot of people look at it is not, it's not the case, because when people think of something as safe, they think, oh, I'm not going to lose money on it. But again, number one, you have to look at, are you talking about real or nominal? Nominal, yeah, you're not going to lose money, but you have to look at the most intelligent people are looking at it in a real way, right? Because again, if you're getting 3.5% on the Treasury, but inflation's 8%, well, you're still down, right? Now again, they would say, oh, it's better than the stock market. Well, yeah, but again, let's go 10 years down the road, right? Let's go 10 years down the road. That's the real question, right? That is the real question. And that's where I think the stock market will far outperform, right? So again, just my opinion on bonds. So again, if you like the video, hit that like and subscribe if you haven't already, and stay tuned for more.